Right now, in Dubai, silver is selling for $91 an ounce. Walk into any dealer in the gold souk, and that is the price. But open your trading app, and COMEX says silver is $73, same metal, same day, 24% difference, and nobody is asking why. One of these prices is wrong. And when you see the vault data I pulled from the last 90 days, you are going to know exactly which one. If you are stacking silver at today's paper price, you need to understand what this gap means for your position, because it is the difference between thinking you own $7,300 worth of metal and realizing it might be worth $9,100. I traced the delivery records across 3 exchanges and 3 continents. What I found explains everything about where silver is actually headed. Let me set the stage for you. Silver crashed 37% from its all-time high of $116 down to where it sits now, around $73 on the COMEX. Gold dropped 12% from $5,500 to $4,632. Every Western analyst is calling this a correction. Every mainstream outlet says the metals rally is over. But here is the number that changed everything for me. While COMEX paper was selling off, the physical premium in Dubai climbed to 24% above spot. That is not normal. A 5 to 8% premium is standard in the Gulf. 10% gets attention. 24% means something has fundamentally broken in the supply chain between paper markets and physical delivery. And it is not just Dubai. The Shanghai Gold Exchange is carrying a persistent 5 to 13% premium over the LBMA fix. India import premiums are elevated well above tariff levels because of wedding season demand stacked on top of record industrial consumption and institutional accumulation. Subscribe right now, because what I am about to show you is not on any mainstream financial channel. 3 separate physical markets across 3 continents are all telling the same story, and that story directly contradicts the COMEX paper price. The question is, which price is telling the truth? And by the end of this video, you are going to have your answer. Let me walk you through the actual size of this gap and what it reveals. The COMEX spot price for silver as of April 5th sits at $73.49. That is the number you see on your phone, the number Bloomberg reports, the number most financial advisors use to value your portfolio. But the COMEX spot price is a futures-derived number. It reflects paper contracts settled in cash, not physical metal actually changing hands. The majority of COMEX silver futures contracts never result in physical delivery. They are rolled, offset, or cash settled. The price you see is the price of a promise, not the price of the metal. Now cross the globe to the Dubai Gold Souk, the largest physical precious metals market in the Middle East. Dealers there are quoting silver at approximately $91 per ounce for physical delivery, metal in hand, walk out the door with it. That is a $17.51 premium, or 24% above the COMEX price. Let me say that again so it sinks in. 24% for the exact same metal on the exact same day. If you went to London, you would find a different price. If you went to Mumbai, another price. Singapore, another. Every physical market in the world is telling you that $73 is a fiction. Do you think silver is worth $73 or $91? Drop your number in the comments. I want to see the actual split in this audience. Now here is where the investigation begins. Why does this gap exist? There are 3 drivers and they all point in the same direction. The first driver is vault stress. COMEX registered silver inventory has been declining for over 3 years now. According to the latest CME Group warehouse data, registered silver, that is the metal tagged and available for delivery against futures contracts, stands at approximately 84 million ounces. Sounds like a lot until you do the math. Open interest on silver futures represents claims on over 400 million ounces. The paper to physical ratio is approaching 5 to 1. 5 paper claims for every single ounce of deliverable metal. Now think about what that means in practical terms. If even 20% of those contract holders stood for delivery simultaneously, there would not be enough metal, not close. The COMEX would have to settle in cash, and when that happens, the paper price becomes meaningless. Physical buyers in Dubai, Shanghai, and Mumbai already understand this. That is why they do not wait for COMEX settlement. They pay the premium and take delivery now. Every dollar of that premium is the physical market voting that the paper price is wrong. The premium is the market telling you that $73 is not the real price. The second driver is the East versus West divergence. And this is the part that should wake up every stacker watching this. While Western institutions, Wall Street, COMEX traders, and paper market participants were dumping silver futures during the recent crash, the East was buying physical, not just buying, hoarding. The Shanghai Gold Exchange has maintained a 5 to 13% premium over the LBMA fix consistently throughout this entire sell-off. Chinese central bank gold purchases hit record levels in the first quarter of 2026, adding over 60 tons in 3 months. India imported more silver in March than in any month since 2023, driven by a double demand surge, industrial consumption for solar panel manufacturing, and traditional investment buying during the spring wedding season. The Perth Mint reported elevated demand from Asian buyers. The Royal Canadian Mint has seen increased allocation to institutional Asian accounts. If this data surprised you, hit like right now. Most people have no idea this is happening. Think about what this means. One side of the world is selling paper contracts. The other side is hoarding the physical metal. American banks sell paper. The rest of the world buys physical. That is not a correction. That is a wealth transfer in slow motion. Markets transfer wealth from the impatient to the patient, and right now the East is being very, very patient. They are letting the West crash the paper price while they accumulate real metal at a discount when the paper market runs out of tricks, and the vault data says that day is approaching. The price discovery shifts east, and the East has already shown you what they think silver is worth. $91 minimum. The third driver is supply chain bottlenecks that most investors are completely ignoring. Silver does not just appear in Dubai. It has to be mined, refined, shipped, assayed, and delivered. According to the Silver Institute, global silver mine production sits at approximately 830 million ounces per year, but annual demand now exceeds 1 billion ounces when you include industrial consumption. That is a structural deficit of roughly 170 million ounces for the fourth consecutive year. Solar panel manufacturing alone consumed over 200 million ounces last year, and that number is accelerating as nations race to meet energy targets. AI data centers are emerging as a new source of silver demand for thermal paste and electrical contacts. When you have a structural deficit and physical premiums at 24%, the supply chain is screaming at you. Delivery is becoming harder and more expensive every month. Refineries are quoting longer lead times. Dealers in the Gulf are paying above spot because they literally cannot source enough metal through normal wholesale channels. The all-in sustaining cost for most primary silver miners sits between $18 and $22 per ounce. At $73, they are profitable. At $91, they are very profitable. But even with profits, they cannot ramp production fast enough because new mines take 7 to 10 years to develop. Now here is the revelation that ties all of this together. The gap is not random. I went back through 90 days of COMEX delivery data and Dubai dealer quotes. The premium started widening in mid-February, right when COMEX registered inventory dropped below 85 million ounces, and commercial traders on the COMEX flipped their positioning. Large commercials, the banks, reduced their net short exposure by 18% in 6 weeks, according to the latest CFTC Commitment of Traders report. They are not betting against silver anymore. They are quietly stepping aside. And when the banks step aside, it means they know something is coming that they do not want to be short against. Let me be honest with you. When the banks stop shorting and the physical premium in the East hits 24%, that is not a coincidence. That is a signal. The institutions that have suppressed this market for years are repositioning. JP Morgan, the largest holder of physical silver through their custodianship of the iShares Silver Trust SLV, has not reduced their position despite the paper price crash. Bank of America's metals research team recently noted that physical silver markets are showing unusual tightness relative to the futures curve. Goldman Sachs raised their 12-month gold target to $5,000. The smart money is not selling. They are letting the paper price drop so they can accumulate more physical at a discount. This is not speculation. This is the data. And here is the part nobody is connecting. The Dubai premium, the Shanghai premium, the Indian import surge, the COMEX vault drain, and the commercial short reduction are all symptoms of the same disease. The paper market has lost its connection to physical reality. The price is crashing, but you cannot buy the product at the paper price. That is a magic trick, and magic tricks do not last forever. Physical reality always wins, every time. The only question is timing. So what does this mean for you specifically? If you are holding 100 ounces of silver and you value it at the COMEX price, your stack is worth $7,349 today. But if the physical market price is closer to Dubai's number, that same stack is worth $9,100. That is $1,751 of hidden value sitting in your safe that the paper market refuses to acknowledge. Now consider the two scenarios. Conservative case, the premium narrows and COMEX rises to meet physical reality somewhere around $82 to $85 per ounce by Q3 2026. As vault drawdowns force price discovery higher, your 100 ounces goes from 7,300 to 8,500. That is a 16% gain from paper catching up to physical. Bullish case, physical demand continues to outpace supply. The structural deficit deepens past 200 million ounces, and silver reprices to close the full geographic gap. That puts spot at $90 to $95 by year end. Your 100 ounces crosses $9,000. Based on the historical pattern, my analysis suggests the conservative case is the floor, not the ceiling. The signal to watch is the next COMEX registered vault report. If registered drops below 80 million ounces while open interest stays above 400 million, the paper to physical ratio breaks 5 to 1, and the premium gap will widen further. Every individual must assess their own circumstances and risk tolerance, but the data is pointing in one direction. There are three types of people watching this video right now. The first type is scared. They see the 37% crash from 116 and they want out. They are going to sell their physical silver at the paper price and walk away. The second type is confused. They see the paper price and the physical price telling two completely different stories, and they do not know which one to believe. The third type understands exactly what is happening. They see the East stacking physical, the vaults draining, the premiums widening, the banks reducing their shorts, and they know that physical reality always wins. The question is not if, the question is when. Which type are you? Tell me in the comments. Every reference is in the description below. If you want these alerts before the mainstream catches on, subscribe and hit the notification bell. Share this with someone who is still pricing their stack at the COMEX number. They really need to see this. And go watch the video on screen right now because it explains exactly what happens when COMEX vaults hit critical levels and the paper market runs out of metal to deliver.